Wanted to open up by thanking Pavel and the MIT Enterprise Forum Central Eastern Europe for organizing this webinar. I think it's very timely. Whether you're a VC or a business angel like myself or a startup, you are probably wondering what's going on right now in the world and how it'll all affect each of us individually and professionally. So the timing, I think, is very good. And let's hope to have some insightful conversation today. A little bit about how we plan to conduct this hour and a half that's in front of us. We'll start by introducing our panelists. So each of them will have the chance to kind of talk a little bit about themselves and the institutions they represent. Then we'll have a presentation by Yoram from Deal Room, which will kind of shed some light on some facts and figures about the world we're in, with a focus on Europe and the European ecosystem of venture investing and startups. So after Yoram's presentation, which will roughly take, I don't know, Yoram, 10 to 15 minutes from what we've discussed, we'll launch into the first wave of discussion. I'll ask the panelists some questions falling broadly into three categories. First category is just what's going on, how different it is from the past crises of the likes of 1987, the dot-com bubble, and the big crisis of 2008, 2009. So is this something fundamentally different, or is it not? And what will the recovery from the crisis be like? The second group of questions is going to divide us into the camps of optimists and pessimists, because I'll probe for whether opportunities outweigh the threats in what COVID-19 brings us, or whether the reverse is true. And the last group of questions will fall in the camp of how it'll affect all of us from the standpoint of VCs doing their business in a very different way from the past, and from the startups having to cope with the consequences. So following this round of questions and this discussion, we will then launch into the Q&A. We'll answer some questions from the audience. The audience has in their panels a Q&A button, which you can pose your questions to us. If they are not addressed during the webinar, we will be addressing them post. Just wanted to briefly mention that the recording from the webinar will be available, and the presentation that Yoram is going to share is also going to be available for you to download. So without further ado, let's kind of quickly go into the introductions. Myself, as I briefly mentioned, I'm a business angel, sharing my time between Warsaw and Silicon Valley. I'm kind of the age category that remembers crises like 1987. So the memory serves me very well, and I have quite a good vantage point to compare what's going on now and what was going on then. Let's start from the east and go westward. So Debneel Mukherjee of Decacorn VC, Singapore-based, but the world is their oyster. Debneel was founder and is a managing Decacorn. Please say a few words about yourself and the fund.
Sure. Thanks, Darius. Decacorn is a Singapore domiciled fund. But as Darius says, we believe that world is our oyster. So we really look for outstanding plays in great startup destinations around the world. And towards this, we have quite a few investments in United States, in Europe, as well as in Asia and in Singapore. In Asia, we have even in places like India, and in Europe, we have even investments in faraway places like Estonia. Besides having investments in Israel as well as in the United States. A brief about me. I've been a banker and then had my own startup which would be then called a fintech, which I ran from 2001 to 2011. And that's where it had a wonderful exit where I made my first capital. Then been a co-founder for Accelerator Incubator, and now where we had some very fantastic exits, and now run a full-fledged funding initiative, venture funding initiative, where we even are co-investment partners for Singapore's sovereign funding initiatives under SG Innovate, essentially giving us the runway to do early stage investments, while our focus is both on early as well as in growth stage. So that's
great. Thank you, Debneel. So now let's make a big leap westward. And Jordan Shapiro, a New York-based partner for New Enterprise Associates, a First League fund, but also with some interest in Europe, and currently residing in Chicago, as we learned in our preparatory discussions. Jordan, please say a few words about yourself and NEA.
Sure, there you have it. Well, NEA is a large global venture capital firm. We've been around for about 42 years, and we're one of the largest and most active firms in the industry. So we are very lucky to say that we've invested in just about 1,000 companies over time and have had something like 650 upside exits, IPOs, and M&As as a result of our work. And then in addition to our track record, we're investing out of one of the larger venture funds in the world, $3.6 billion fund that we raised in March of this year. And then I've been at NEA for the past 3 years, focused on technology investment across the US, but also globally. We spend a bunch of time in Europe, so very excited to be here today speaking with everyone.
Great. I guess the vintage of your fund bodes well to the future returns. If
it was well timed.
Thanks. Debneel, you've been around for a while, and you've had the chance to go through a few of those crises. What's going on here? I mean, is this really kind of a black swan event not seen thus far before, or is it just one of many to be expected with the impact that is going to last a few months and then back to business as usual? How do you see that?
Yeah, I guess definitely this is not a black swan event in the way that the world hasn't seen. But then our view is that this is not something comparable with global financial crisis or the Great Depression of 1929, or even the dot-com bubble bust. Rather, we would call this like an exogenous shock. And something like this happened on the Black Monday of October 1987, when the markets crashed suddenly. And then we saw it also happening post or around 9/11, the terrorist attacks. So we'd rather compare this with that. And then what we basically see happening from here is that the markets continue to follow the trend line that has been there prior to. Like in 1987, the markets were on their way up. And this, I'm basically talking of US markets, because the Wall Street is basically the world's leading indicator. And whatever we say and do, most of, or the whole world indices and bourses, they all finally move lockstep with the Wall Street in most part of the time, or most part of the time than otherwise. So 1987 markets were going up. After the crisis, the markets continued to go up. 9/11 markets were going down post the dot-com bubble bust. Markets continued to go down. And so that's again a déjà vu happening now. After the crisis, 23rd of March was probably the bottom out for the Wall Street. And then from there, it has started coming back with vengeance. Today, if you see, even I think last week on 5th of June, we actually saw the Main Street catch up. That's where first time 2.5 million jobs were gained, as against an expectation of a 7.5 million job loss. So basically the expectation or the plans were off, or estimates were off by 10 million jobs. So that's where the first bottom formation in our mind happening in the Main Street. And that's where the Main Street has started coming back. And given that, Wall Street is always anticipatory, it will always run ahead. What has happened differently this time is that since about, this has been happening since 2017 when the trade wars and all that has started happening. The indices, the NASDAQ has started breaking off from Dow and from S&P. And while if you see on their way down after the COVID, NASDAQ fell just about 25, 26%. Dow and fell almost 33+%. So normally in statistics, that comes back faster, the one which goes down when there's a mean reversion. But that didn't happen either. NASDAQ came up with a vengeance. It reclaimed not only its high, but it has now gone into its lifetime high. But Dow as well as S&P, they haven't been even to take able to take out their highs. So that shows that there is a polarization happening between the old economy and the new economy, the tech economy. And from here, therefore, what we believe is that the tech adoption curve, which would have taken 5-6 years to happen, has probably happened in 5-6 weeks. And that has been extremely positive for all those who have been, of us who have been in tech. And from here, what we therefore see is that, it's another very interesting thing is happening is that there are 5 main disruptive platforms that is working now. And if I take you back to the 50 years on the run up to 1929, post the Spanish flu and post the First World War eras, those days it was electricity, it was internal combustion engines, and it was telephone, 3 platforms that literally brought us to roaring 20s, probably the most affluent part of history, American financial history. And today we have 5 platforms working there: energy storage, blockchain-led digital wallets and cryptos, then gene therapeutics due to enhancement of the computing power, as well as AI and robotics. And then finally, super enhancement in our computing abilities, computing powers, things that could not have been done earlier, now can be done very, very easily. With so many platforms working, probably we are now getting into a roaring 20, second roaring 20. That's where we see it happening in the next 10 years. So that's where I think it's a very big game changer. What will take a backseat here from old economy? Oil, not going to come back anytime, anywhere, probably what we have seen oil ever in the past. And third, geopolitically, I think there will be trade and globalization will suffer a big way. What we will rather see is nationalism, protectionism. A lot of things that were now being produced in East Asia, China, Korea, Japan, Vietnam, Cambodia, they will all now move near shore or onshore. And again, technology in terms of AI, robotics will further enhance this. And that's where I think we will probably see a very, very polarized world where VCs again will try to focus more into their backyard rather than going global. So that's the overall take.
So, thanks for this perspective. It's very interesting, and this sort of divergence between the Main Street and Wall Street is a very interesting one. Also, I think what you're saying kind of dovetails with some analyses that I think all of us have seen about the fact that tech stocks and tech invested in private capital basically still is one of the most attractive asset classes for the LPs, and probably at some point in time Masayuki will have the chance to comment on this as well. So very, very interesting. But I'm still looking for pessimists, and you definitely don't belong in that camp. Many themes that I think our previous panelists identified. Jordan, what does your perspective from high rise in Chicago look like? You're not
sure. No, but happy to give kind of our perspective as a large, U.S. blue chip fund. I think it confirms a lot of what my fellow panelists have mentioned. First of all, there is a lot of conservative, wary behavior, I think, being taken by funds right now, despite having fresh capital. And if you look at the invested dollars over the past few months, you'll start to realize that the trends are to invest a good amount of capital, but also so in a risk-averse way. So there are a few ways to do that, right? One is, of course, a lot of large VC funds doubling down on their existing investments, making sure that they're shored up on capital. So immediately as COVID hit, most funds went back to their companies and scrapped plans for the year, revised budgets, started to think about how they could lock down capital at least for another 12 to 24 months, ourselves included. We did that with all of our portfolio companies across the board. So that was a good chunk of that dry powder that went straight into existing portfolio companies. Then there were a bunch of firms that went out and looked for growth investments. So strong companies where you could already look at the numbers and have a very clear sense of the trajectory. And despite the wavering macroeconomic factors, have a pretty solid sense of confidence that this was a company that would grow and yield a strong return for your fund. And then there were a big number of investors that went out and looked for these COVID tailwind companies, which I think are a sector in themselves, where if you're a remote working company, a teleconferencing company, a telemedicine company, you are way more attractive to a venture investor today than you were 6 months ago. Although your field was already growing, you suddenly become this asset that is very nice to have in a new fund. And all of these things are typified by being solid risk risk-averse investment categories that venture investors have flocked to over the last months. The real question, I think, for startups is, how do you go raise money if you're not in one of these categories? And as investors, how do we think about getting back to our normal business, which is not necessarily growth investing, not necessarily just doubling down in our own companies? So where exactly do you invest? And I think this is where you're going to see some potential headwinds for companies that go out to raise. So if you are a European company and are trying to raise from US investors, there's a little bit more friction there in that you won't be able to meet those investors in person, but also in that we might expect that you have more local investors on board to help you navigate through turbulent times. If you are a company that is in a heavy industry, and that industry is potentially impacted severely by macroeconomic factors, we're probably thinking twice about investing. So we're probably going to wait that category out. So take manufacturing, for example. We might wait for another 6 to 12 months before we invest in a specific type of manufacturing marketplace for labor, for example, because we want to see how automation in that industry and how COVID impacts that industry more generally before we'll move forward investing. So what you see here is, a lot of VCs are describing the situation as their bar is higher in investments. I actually hate this term because by implying that the bar is higher now than it was previously, you imply that you were okay making just okay investments at some time, or good, not great investments. I don't think the bar is higher now than it was before, but certainly the scope has narrowed and has shifted to certain categories. And as we think about making new deals, which we have done, and we have closed new investments and closed fully remote investments, the thinking for a fund like NEA is that we need to be convinced that this is a company that can last over the next few years. We might be investing more dollars to help them get through what could be a tough time, but also that the current tailwinds and the general secular trends of the industry are going to support this being a very sustainable business. We're not taking massive technology risks. We're not taking massive founder risks in a period like this.
Great, thanks for this perspective. Let me kind of go back to what Martin said and ask all of you who are kind of in some shape or form exposed to the world of startups. What are you, in fact, telling right now to your portfolio companies if you are a VC? Your VCs you're investing in, like in case of JBIC, IG Partners. What are you telling them? What is kind of the message that you leave them with? And the second question is, what would you tell to companies seeking the funding right now? What should they do different from what they did in the past? So starting with the, let's say, existing portfolio companies, what do you tell them? I'm kind of throwing the question. Whoever is ready to answer, please jump in.
Maybe I can go first. So what we are basically looking very far, so we being in the East, we had an indication of this quite early. And we have been, both at the government level as well as the civil society level, we have been taking precautions almost towards end of Jan. And we had a previous experience even in SARS, which most of the rest of the world hasn't seen. And hence, coming from there, I think early Feb, we called all our founders and told them that please get to the deck and run a very tight ship, cut down costs and enhance your runway. Because that's the only way to survive, because that point in time, we had no clue that how long it's going to sustain itself, or the apocalypse going to continue, and when we will see light at the end of the tunnel. Then I think a lot of things has changed, and particularly again, lead indicator America has actually been a forerunner in this. The kind of support, financial support by way of quantitative easing, including the Federal Reserve has done, is amazing. I mean, the money that has been thrown in those first few weeks is not even, it's 2 or 3 times more than the money that was thrown off even in the entire global financial crisis. So that's humongous support, and that support, whether when there will be inflation or not, obviously those challenges are there, but then those are problems which we can see 2 years later surfacing, and there are very many ways today available in our world to tackle them. And in any case, we are in a high growth scenario, so we can outgrow the inflationary pressures as well. But then the second thing, therefore, we are now telling them, as this support came into our startups, go out and go be quick. We feel that, you know, this market will continue to go up, at least, or the lead indicator will go up, and the sentiments will be good for quite some time now to come, especially given this is an election year. So until the American elections, there will be a lot of support. And indexes will make to look nice, markets will be made to look nice, because that's also a part of our positive emotions. And hence, this is one of the best period to raise money. So we have even put our companies, whoever need money, to go on an overdrive and see what they can mop up. And so basically coming from the fundamentals that bask as long as the sun shines. Post early next year, probably we can see, or we have to prepare for maybe a slowdown. The third thing that we have told our startups is that completely revamp your business, because a lot of things are not going to be the way it was. So if your customers were in old economy, try to see how their businesses are going to be getting affected. And that, as Pavel said, like a lot of ways we will not do things anymore. So how that transition will happen. So I see Coca-Cola behind you. So one of our startups have customer in Coca-Cola. So we have told them that go and see where Coca-Cola is affected and what they are going to do next, and try and attack that area. In fact, if required, that if there is a customer and a B customer, and you think that the A customer's business is getting impaired because of this COVID, while the B has probably is in the Amazon space, go after B more and put your marketing dollars more in getting more businesses are spending from B rather than focusing on A. So the complete shift in the go-to-market strategy has also something we have put in place. Now, overall, what we feel about us as VCs is also what we think they are going to be affected. 3 things probably are going to happen. First, there are a lot of companies who have been benefited due to COVID. Let's take the vaccine companies. I think chasing them is like chasing a mirage in the desert. It has again and again happened. Our track record with vaccines has been terribly poor. We do not have HIV vaccine. We do not have Ebola vaccine. Our influenza vaccines don't work. So probably all these vaccines are all hype, and anybody putting money there or running after all those probably is going to get themselves burned very badly. SARS, also the same thing happened. We will not probably get a vaccine. If we get it, it's wonderful. So we have to go through the herd immunity. We only hope that our politicians have learned their lesson. This time they are prepared and they don't start and stop our economy. as maybe there's resurgence when we open up. And then the third thing that we are telling ourselves and also our economies is that our startups is that we cannot support anybody and everybody. Going back and giving money to our own portfolio companies just because they are our portfolio companies is the biggest mistake that we can do in these times. We have to be extremely selective. The businesses where we feel that they are impaired because they may be soft touch, they may be low touch, they may be in the marginalized spaces where they were doing more of a quick flip kind of a startup rather than a sustainable high impact startup. Probably they are all going to be finished. They will lose their shirts in a year or two, and particularly next year when things go really bad. But those who are therefore in a very good space and a space where they are high touch, and from here they have a lot of technology to play ball around and build up a sustainable high impact business, a business that has a lot of adoption curve going forward. It's really disrupting large opportunities either existing or getting newly enabled. Like we feel blockchain will come out, let cryptos and Bitcoin will come out big time because fiat currency is losing its value because of this printing, and it will devalue, and gold cannot be a safe haven. So those have the opportunities. So those are the places where probably we will see a huge traction. That's where we want to put our money, and that's where we want to support startups where they are coming out, not just because they are our existing companies, and just because they are existing companies, we go Bresek and support each of them. Those who have failed or the landscape has changed, we have to put them to grave quickly. So that's the way we are handling it.
Contrarian perspective, especially with this aspect of avoiding the hype. Every company in the medical diagnostics space I know just basically threw a bunch of resources right now at COVID testing kits and things like that. So too much pivoting going on there sometimes.
They will all lose their shirt.
Yeah. Jordan, a question to you, because I'm kind of curious how kind of an ordinary day-to-day life of a VC and a startup is affected by all of this going on. Like, if I'm a company wanting to convince you to invest an A round in me, how is this different now compared to what it used to be when you can't travel, you can't do sort of your due diligence in the way you did. How is this kind of business happening right now for you guys?
Yeah, it's a really interesting question, as a lot of these processes are shifting from very in-person diligence processes where as VCs we're very used to flying out and meeting our companies where they are and sitting in the office and sitting with the team for days to totally virtual processes. Here's what I tell people. First of all, in general, the advice we give is raise more capital if you can get it. Treat your cash as very sacred right now, and then focus. And focusing in terms of what's going to allow you to raise capital can vary depending on the business. If you're pre-launch, maybe that's focusing on your product to have a really strong story for us. If you're pre-monetization, maybe that's focusing on your user adoption. And then if you're a post-launch, already making strong sales business, focus on the key areas that are going to be safe throughout COVID, because that's what we're going to focus on right now as investors. There being a very clear story for why your company is ready to raise capital and why now rather than 12 months from now when we have more perspective on how the market has developed. And then in terms of the practicality of how our diligence process changes, if you're a founder, expect that potentially all of your meetings with an investor could be remote, could be virtual. Expect that if that's the case, you might be having many more of these meetings and that they might be spaced out more. For companies that have gone through our process, they've met a lot more of our partnership before going to final partnership meeting. And the idea there is we need to get more comfort around the founders. So we've amped up our sense of doing background checks. We've amped up our ability to reference founders while we're going through processes. And then we're going to spend just as much time as normal, going through your data and going through the history and trying to meet the team, but it will have a little bit of a different flavor, really, because we're trying to get that comfort level that we can't replicate exactly from being in person with you. Otherwise, I would say, you know, from the day-to-day perspective as a venture capitalist, it doesn't feel all that different. You know, we're lucky in that our jobs can be relatively virtualized with you know, with minimal effort. So the real question for me comes down to, you know, how do you gain that comfort level over the phone with someone who could be miles and miles away from you in a totally different country? And we'll have to compensate for that on the back end of making these investments with spending more time with our teams, either in person or just on video chats to build up rapport.
Great, thanks. Jordan, anything to add on that pivoting front? Do you see the need for it among your portfolio companies?
Yeah. I'll start by saying that it depends. NEA has hundreds of active portfolio companies, so it totally depends on the company. You might be a med device business versus a high-level consumer software business, and the market environments there are very, very different. In general, you know, we're not telling people to pivot as much. We're telling companies, like I mentioned, you know, focus on what it is that is your core, you know, your core OKR for the year, your core, you know, result that you need to achieve, whether that be to fundraise or to know that you've met your milestones. And then beyond that, if we are telling you to pivot, it's because your current business model is really just incompatible with the post-COVID environment. So the companies that you'll see take the largest pivots are companies that required brick and mortar presence or some sort of in-person meeting, or all of their sales were very high touch and required in-person conferences. And you know, that might just be pivoting a sales team and a tactic. But generally, you know, we're trying to keep pivots to a minimum here, because doing so introduces even more risk into the company. You don't know what the business will look like on the other side of that. There are a few cases where we've had to do it. Businesses that, you know, might have been focused on meetups and had, you know, potential to do some virtual element, but then shifted entirely to the virtual side of meetups, or companies that were selling in retail, but also were selling e-commerce. And e-commerce was a small fraction of the business, and now has become the main or only sector. Those are the types of pivots we've done. But functionally, you've got to focus on the core fundamentals of your business. And at this point, if you're floundering around looking for a new business model, it's a really difficult capital environment in which to do so.
Great, thanks. Guys, we're nearing the end of our time contract here. So I just wanted to give you sort of one more opportunity to provide us and the participants, people watching, some pithy way of summarizing this discussion. Do you have some words of wisdom and kind of a quick summary of where does the post-COVID-19 environment take us? Who would like to take a crack at this?
Sure. I guess our thematic is the world is our oyster. And our thematic is that we do not belong to any race, any region, any caste, any community. We only believe in outstanding, sustainable, high impact startups that can make our planet few shades better than what we inherited from our parents. So towards that end, if we see wherever they could be Latin America next, Africa thereafter, we don't know. So money will automatically, not just for us, I think that automatically the smart money will always move there. There are some basic structural problems in the European startup community ecosystem that as we see it. And unless those structural problems are addressed, I think there will be challenges. And as I said in the earlier part, one of the things that negatively is going to happen from here, COVID, something started a few years back. We didn't realize it then so big way, but COVID has also accelerated those. Like the technology adoption curve is getting accelerated, so is getting accelerated is nationalism and protectionism. So now when we see a lot of stuff happening near home and in our backyards, obviously the money will be flowing there simply because of comfort factor. And in that, therefore, the next will happen is where most of that work is happening. So these are a few challenges which are still there. And again, there are blue oceans. As I said, Africa is a complete blue ocean. I mean, even simple things that work for the rest of the world and certainly for the developed countries doesn't work there. How you pay the taxi driver in Nigeria, it does, the Uber driver, it doesn't work. So therefore, there is a huge opportunity curve there. So again, therefore, Europe has to think it out of the box and think it really, French founders only looking at growing France. They don't even want to go to Germany. I think that doesn't work anymore. I mean, they have to really think that the world is our oyster.
Okay, anybody would like to add to this?
So I'll say, it's important to acknowledge that we are in a time of, fear and pain worldwide, and a lot of randomness and risk is rapidly introduced into our market. That said, what I'll say is some of the most valuable venture opportunities globally were created in market dislocations, including a lot of NEA's landmark investments. So if you think back to our investments in Workday or Salesforce or Groupon or Tableau, all of these were in market dislocations historically. So, with that recognition, despite all that's happening in the world today, I still think now is a great time to start a company and a great time to build a lasting business. And we are happy to have our fresh powder, our dry powder in our 17th fund. And we are actively looking for investments. So Pavel, to answer your question, yes, we're still with you. Yes, we're still excited to meet companies. And I still think there is a ton of really exciting work to be done in the venture industry.
So to sum it up, I guess the times are tough, but to use the old cliche, when there's money, there's blood in the streets, this is the time to hunker down and create those well-performing vintage funds, as you guys were pointing out. And from the perspective of the startups, a good idea and a great founder team is always priceless. So don't shy away from setting up a shop and looking for investors, because they're still out there looking for you guys. Listen, thanks a lot for participating in this discussion. Thanks to my panelists, and thanks for the participants who hung on and asked some good questions. Sorry we couldn't answer all of them. Some of them were kind of interesting, but not let's say specific to the discussion we're having about the post-COVID world. But we'll try to answer them. We'll try to answer them all, and we'll pass them on to people that they specifically concern. So once again, thank you. And for the folks who are watching us, again, the recording of this is going to be available. The organizer is going to share that, I believe, on Facebook. And I encourage all of you to download the fact-filled presentation by Yoram, who I'd like to extend special thanks to. So thanks, and you all stay safe. Invest,
thank you.
Start things up.
Thanks, Darius, for moderating the discussion. Thank you.
Thank you very much.
Thank you very much.
Thank you very much.
Bye-bye.
Bye.
Bye.
Goodbye.